it's like 50-50. I'll talk to somebody and they're like, oh yeah, sweet, QSBS. And then I'll talk to the other half of people and they say, what is that? Probability say like maybe not going to happen that often. But when it does, you as an angel investor need to be aware of how you can potentially mitigate, or in many cases, erase capital gains tax. They want to incentivize early investors, venture and angels, to invest in startups. Traditional VCs are hyper aware of QSBS because they totally qualify as well. The reality is that most angels should be paying attention to 1244 losses. The punchline with all of it is if you are going through any exit at all, or you're about to, you see the writing on the wall, it's time to get your ducks in a row.
Welcome to The Diligent Observer, where we help angel investors see what most miss. I'm your host, Andrew, and every week we explore what works, what doesn't, and why through conversations with experienced startup investors and operators. My guest today is Bryan Hasling, a partner at Modern Financial Planning, active angel investor, and a wealth management specialist for families working in tech and startups. In this episode, Bryan breaks down how angel investors can legally pay zero capital gains tax on their biggest winners up to $15 million, shares why the timing of an investment matters a lot, and walks through how to turn a losing investment into a serious tax benefit. Now, we get into a lot of nuance today, so as always, just a reminder that this is not investment or tax advice and is being shared for educational and informational purposes only. I hope you enjoy learning from Bryan as much as I did. Bryan, thank you for being with me today.
I'm happy to be here, Andrew.
Okay, so Bryan, normally I ask the guest what they're excited about, but today I'm going to start with what I'm excited about, and that is the fact that we're going to talk about tax wisdom and best practices for angel investing. I spent a lot of money on an MBA, and one of the key takeaways was that one of the easiest places to go find untapped value is in tax strategy. And so I'm super excited today to talk about what is a really boring, kind of forgotten topic in the world of startup land, where we're all excited about the actual tech in the future and the innovation that's happening. And we often forget that the actual mechanics of what we're doing here matter a whole lot. So really excited to hear more from you on how you're seeing that done well in and through your practice. So Bryan, well, glad you're here.
Yeah, I'm glad to be here. You're the first person to say that to me in a while. I'm excited about this. Yeah, taxes is one of those like necessary evils. It's like we want to pay our fair share, but we don't want to leave a tip kind of thing. So, and oftentimes it definitely pays dividends to kind of know at least like some of the big wins you can get. There's a million small little like, death by 1,000 cuts when it comes to like tax strategy or tax savings, like maybe. But today I want to cover some of the big ones and specifically how they might help angel investors. Because angel investors are subject, or they do have more tools available to them on the tax side when it comes to making investments, whether they do well, which we hope for, but also sometimes when they don't do well, there's also some things to be aware of there. There's lots of like nooks and crannies that, caveat, there's a lot of rules and check boxes to hit. Can't cover them all, but at least introduce them to you and everyone.
Fantastic. Well, I look forward to jumping into all those. Maybe we can start with what you see as some of the most common or most surprising things that you would think. Like, you're a tax guy, so you understand a lot of this stuff, but what are some of the things that you have found surprising that most angels don't think about or don't know about that are available to them?
Yeah, I mean, the big thing is realizing that there's a lot of tax things out there. You can be a founder. If you're a founder, you have certain things that are available to you because you're running a business, but you're also like a major shareholder. You have a lot of things. If you're running a venture fund, you've got like a different hat on typically. But if you're an angel investor and you've made an investment in something, we hope for the best. We know the odds. We know the odds and the probabilities and the statistics of like how many are the big winners and how many are not. So when we talk about some of the advantages for some of the big winners, we have to know like, probabilities say like maybe not going to happen that often. But when it does, you as an angel investor certainly, you certainly need to be aware of how you can potentially mitigate or in many cases erase capital gains tax. That's the big one that we're solving for, or we want to introduce to the audience. On the flip side of it, maybe more common, unless you're a superb investor, like I'm sure your audience are. They're all
Only the
winners.
best listen to this show.
Yeah, it must be just my friends who, But when things don't go as well, or maybe a company doesn't make it, shuts down, oftentimes there are ways to kind of like, take the edge off on the tax side when it comes to write-offs and, sweeter deductions than you might be aware of. So I want to introduce both of those at the very least today.
Well, let's start there. Let's talk about the winners first because that's more fun. But then I would agree that the capitalizing on the losers is more common. So let's start with the winners. What's the miss that you feel like?
So from here on out, everyone's winners. 10 out of 10. Whenever you make any investment, let's just say you have a normal like investing account, you have a Robinhood account, a Schwab account. If I make a purchase for anything at $100 and I ended up selling it for $1,000, the difference in there, that gain part when I sell, is a capital gain. Capital gains rates, they kind of depend on what you've got going on. For our audience, the majority of what you'll see is, tax rates are like either 15% most commonly, or if it's a higher income year for you, it's going to be 20% of the gain. Whatever you put in is already yours. But the gain part, you're looking at maybe 20% in capital gains tax. There's another tax to be aware of, another bummer. There's this thing called net investment income tax, sometimes lovingly called Medicare surtax, and that's another 3.8% generally. So just in your mind, 23.8% of long-term capital gains, that's what your tax rate is. If you as an angel investor invest early and you check, qualify, and you hold for the amount of time, I'll talk about all these like requirements in a second. But if you invest early enough when the company's small, a qualified small business, and you held for a certain amount of time, held long enough, and then you sold later, or like there was an acquisition and you got cashed out, something like that. If you meet the qualifications, that gain basically gets like erased or forgiven or whatever the language, excluded, if you want to use the right terminology, up to certain limits. And so now you might not have to pay that 23.8% tax on the gain. So that's called qualified small business stock, QSBS. There's been a lot of talk about this. More recently, last year, it was a big topic because it made the OBBBA one big beautiful bill act, and there were some adjustments to it. Actually, like the rules got even sweeter and better for early investors. So that's the big one that everyone needs to know about by far.
And in your experience, because you're an active angel, you come from Silicon Valley, you're a part of an angel group. Do you feel like many investors just aren't aware of this? Like, I've been following this, I'm tracking this. We did a special episode when the Big Beautiful Bill published, kind of walking through some of those changes, and I'll include a link to that in the show notes. So to you and me, this is pretty common. Do you feel like most angels are missing this, not seeing, not knowing about QSBS?
It's a house divided. I never know. It's like 50-50. I'll talk to somebody and they're like, oh yeah, sweet, QSBS. And they'll just use it in like they'll use the acronym like in a conversation. And then I'll talk to the other half of people and they say, what is that? Maybe I've heard of it. Oftentimes they haven't heard of it. A lot of times maybe you've heard of it, but you have no idea if that's for you or not. And that's the downside of like the tax code being as vast as it is. The OBBBA alone, yeah, QSBS got some like, it got some mic time or it got some spotlight, but there was also like 50 other things that were like on the table, right? So it's just hard to know like what to focus on. So I guess I'm just here to be the evangelist today. Like angel investors are certainly like they have a chance of qualifying as a QSBS investor, assuming you meet some of the main parameters, which I think we should definitely
Yeah,
talk
I
about.
definitely want to hear about those. But I mean, this is just to make sure it's clear. This is a huge deal because a lot of the time, this is the winners, right? These are the things that drive the entire return of the angel investment or the venture strategy, right? Is asymmetric outcomes with a few companies in the overall portfolio driving the vast majority of returns. And so to
Right.
give up 20 or more percent points on that gain to Uncle Sam versus potentially keeping that in the pocket on a 10 or 20 or 50 or 100 Xer, we're talking real value, even if this doesn't materialize on every deal, having it in place where it's possible to have in place, there's
Right.
just massive implications for somebody's portfolio. So tell us a little bit more about some of the exclusions and then how to like practically, how do I do this? How do I make sure that
Yeah.
all of my qualified investments are getting this treatment?
Yeah. So let's make sure that you know what it is you're actually aiming for. See if it's worth your time. Punchline, it is. And then it's like once you know what you're aiming for, and all your audience members, 10 out of 10, they're going to be winners. What do I do now? Right. So we'll talk about both of those things. So what's the carrot that we're aiming for? QSBS, again, you're trying to get your capital gains taxes excluded and up to certain limitations, right? So it's really just an incentive from the government. And this is all IRS federal stuff we're talking about. I'm not introducing state stuff because some states follow this, some states don't. Let's keep it simple. We're just talking about the IRS federal tax code. They want to incentivize early investors, venture and angels to invest in startups. And so that's when like startups, small businesses, qualified small businesses. If you get in with a qualified small business as an investor and you have held your shares for, I'm going to use the new rules from the OBBBA just for simplicity. If you've held anywhere from 3 to 5 years, at least you will get some sort of exclusion. If you hold for all 5, you get the full exclusion. How much can you potentially exclude? Um, the numbers, the number is really big. It's up to $15 million of your capital gains just kind of removed, right? So that's a big number, right? These are like venture fund level like numbers, but so that's maybe like an 1,000x sort of like return for typical angel techs.
So for a typical 25K angel check, it's never gonna even at 1,000x, right? That's pretty good. You're gonna keep a lot of those dollars potentially if you're able to maximize these exclusions. Is what you're saying.
That's right. That's right. Yeah. So like let's say the average check size is $10,000, you know, and you hit a 10x, like a 10 bagger, and you sold for 100K, that $90,000 now does not, you're not going to get taxed on that $90,000, which definitely affects your after tax returns.
Yeah, no kidding. Okay, so keep going. What are the other like exclusions or conditions I need to be thinking about?
So the big thing, the easiest way to think about it is that to qualify, the the company itself or the startup has to qualify as a qualified small business. That's the very first thing. If the company's too big or if it falls under some of the lines drawn by the IRS, then like don't even waste your time with the other stuff. Right. So you have to hit the company first, and then once that one's a small business, qualified small business, then the investors themselves have a few checkpoints themselves. So the company itself, it's actually not that hard of a threshold to hit. I think most startups, at least the startups that we're seeing in our angel groups, a lot of times they qualify pretty quickly. So I'll go over like the 5 main like checkpoints pretty quickly. So the company itself, the startup itself, needs to be a C corp. That's pretty typical for most startups that are like raising outside capital. But like it's just one of the checkpoints. The big thing is like, how small are we talking about? Well, at the time of your investment, or right before, the company needs to have gross assets of less than $75 million. So $75 million or less, it's a qualified small business. And so your goal as an investor is to maybe look at that. It's easier to just to look at when it comes to like software tech or like SaaS businesses. Like it's really just cash in the bank, few computers here and there. Like it's a lot easier. If it's like a manufacturing sort of deal and they have a lot of assets, right? Like it's like a little bit murkier there. Like it's like the hardware and cash in the bank, right? But a lot of the startups you see at the early stage, definitely like Series A or before, like it's a pretty easy threshold to cover. And you're trying to get your invested dollars in before the company crosses that line. That's important. Once the company or itself raises a ton of money and they've got a bunch of money now and they've crossed that threshold of 75 million, it's no longer a qualified small business, meaning the stock can't be qualified itself. And once you go that way, you can't go back. The water is spoiled, so to speak. So $75 million is the company size. That's the big one. Also, what's important, the shares that you buy the equity that you hold needs to come directly from the company. You have to be directly purchased shares, basically. So originally issued. That's important because in the private sort of equity world, there's a lot of secondary markets out there. You can buy into startups in the secondhand market. Basically, there's a lot of these marketplaces out there. Those don't count. It's got to be like originally issued stock. There's another threshold that's interesting. 80% of the assets in the business need to be directly like aimed at the active business that you're in. That one's more important because there are actually businesses that are specifically excluded from being allowed to like become a qualified small business. So like consulting businesses can't be, QSBS, finance, accounting, legal, restaurants, farming. There's a whole actually list on the IRS website. Those are just like the common ones that I see. So like you can start off as a qualified small business, like stay in your lane. I'm doing SaaS or whatever I'm doing. But as soon as if a majority of your business or assets starts to like be, shifted over here into another realm, or maybe you decided to put a bunch of your capital in real estate as a holding period, like you can really the company itself can negate all of it very, very quickly.
So like I could start a business, if this is a SaaS product, we're going to scale this and sell it to enterprise businesses. That doesn't work out super great for me. It's after 3 years. I'm like, let's just put it into a real estate business. And then, I've totally pivoted the business. You're saying now it wouldn't qualify for those exclusions.
Yeah. And it can ruin like all of it. It can spoil all the milk, so to speak. So those are important. So those are the biggies when it comes to the company itself being a qualified small business, a QSB, so to speak. But then there's like, all right, but what about the stock and investors in the stock? That's the next most important thing. And angels have a couple of not landmines to be aware of, but there's just a couple nuances that are specific to angel investors. I'll explain what. So again, the shares that an angel investor must have, they need to come directly from the company. So again, no secondary markets. It's got to be direct ownership. This is interesting because in my own angel group, we have what we lovingly call a sidecar fund. And the big question is like, well, if I'm an investor of the sidecar fund, and then the sidecar fund itself invests in the startup, if it is a big winner, will those tax benefits flow down to me so that I can take advantage of QSBS?
Great question.
Big question. It's like the question. The answer is Yes, but it depends. I should have just said it depends. It depends how the sidecar fund or it's usually like an SPV type of thing. Depends how it depends on that entity shape and how it files taxes, basically. Most of the time, these like funds, these like SPVs are set up as like pure pass-through LLCs. Like, it's like, yeah, it does a tax return, but the reality is it just like immediately just like spits everything out to the actual like members or the investors underneath. So like if it's a pure pass-through entity, it's really just a conduit to do the pure investing as if it isn't there at all. You just help to divvy up the percentages. If it's a pure pass-through, most of the time you're still going to qualify for qualified small business. So your ownership counts in those cases. As soon as it starts to become like, the fund like holds, it retains some of the earnings and starts to do like funky stuff with management, like now you're getting dangerously close to sort of piercing that veil. But that's a major question that we had to look up in my own angel group.
Which would imply, so the fund itself, so let's say there is management fees. It's more of a traditional VC. Like let's say I invest in a VC, right? There is a management team. They're taking a 2 and 20, and the fund is invested in a company that, like I'm invested in a fund that then invests in a business. How does QSBS work in that instance? Does the VC entity receive that, and then I receive benefits indirectly in my distributions as an LP? Though those would obviously have that 2 and 20 taken off the top. Is that functionally how that would work?
Yeah, management fees don't like negate it by any means. It just so traditional VCs are hyper aware of QSBS because they totally qualify as well. They're going to be setting up their funds like 9.9 out of 10 times to be able to like qualify for QSBS for everyone, just because they know like this is such a big deal. There's a couple things I'll have to like refresh my memory that like definitely like make it not okay. Like if the VC fund actually raises from like if their LPs are like international LPs, right? We're talking like institutional grade like VC shops. That's one of the things that like spits it out. But for angel investors raising via SPV, by and large, like everyone's setting things up as a pass-through LLC. You're a passive investor. Most of the time it qualifies. So
great.
That's a big one there. The biggest landmine that I think that angels are not aware of is being very, very, we need to remember that the exact instrument that you use to invest, remind ourselves that it's not always stock. Like we're making an investment, but we don't actually own stock yet. Or in some cases, stock actually isn't like created. We just have a promise for future equity. Very, very important. A lot of pre-seed, even Series A in many cases. A lot of startups are raising via safes these days. So the big thing is like, well, does a safe count? Does a safe count as direct ownership in the company? And the reality is for QSBS purposes, where I'm trying to hold my shares for 3 to 5 years, at the very least to get something, just remember that a safe isn't actually equity yet. The FE and the SAFE, the FE is kind of a giveaway, like it's future equity. You don't have equity yet, right? So it's same with some of the folks I work with in Silicon Valley who have like stock options. It's not stock yet. You don't get to start your clock. Those folks get a chance at QSBS as well. But it's not stock until you've actually it's been converted to stock. With options, it's whenever you buy them or exercise them. With a safe, you're kind of at the mercy of whenever a price round happens, and then poof, you should have some equity.
Yeah. And it must qualify at that time. So, right, all the other
at that time
exceptions you mentioned, it's got to be under the 75. They've got to be doing the right stuff, not in one of these excluded categories.
That's exactly right. So it's at the time it converts, the time your day one of holding equity is not always day one of when you gave them money. And that's a huge thing. Your clock does not start, but also the company could have gotten super big really fast, which we're seeing in the AI world right now. Like valuations are just getting like ridiculous and they're blowing past these QSBS levels really, really fast. Yeah, we're seeing some of that, mainly, Bay Area AI companies. But yes, you're right. It's at that time, whenever the price round happens, or just whatever whatever you had, your mechanism gets converted to stock. That's day one, and at that day one, you have to look around. It's like, do I meet all the criteria? So safes are the big one, and just the other one is convertible notes, also not equity. So we just have to remember that when we're deciding on should we do this deal or not, they'll say what they're offering. It saves convertible notes and direct equity, preferred stock, safes and convertible notes. They're not equity yet. Preferred stock, those things actually count.
So Brian, maybe you'll get to this, but a big question that's blasting in my brain right now is like practically, okay, let's say I'm fairly confident that this deal qualifies and I want to make sure it gets the exclusion applied and all of that. How do I document this properly? Like I've got a CPA that I work with. Let's say I've got a legal counsel that I trust. I've got a team around me. But like, what do I need to do to document all this to make sure that my ducks are in a row from a compliance standpoint so that in 5 years from now, when this thing does exit and I'm about to have an awesome year, I'm able to properly, apply those exclusions when I file for that year.
Yeah. This also came up in my own group because we realized that it becomes very, very apparent that how am I supposed to prove that the company itself, which is the very first hurdle, was small enough at the time of my entry point. That's been the hardest thing because the companies themselves, like they're the ones who have the books.
Right. And it's 5 years ago. So nobody remembers anything from 5 years ago.
They could have changed softwares, like who knows?
And this is at the company's messiest too, right? Not only is it a long time ago, but it's also when it was, Joe at his desk with the, team working out of the house. Like it was very small and
It's actually a huge problem, I think. And I want to do more about this to promote this. I want to start with my own group, but we started talking about whenever we are ready to make an investment, what's our QSBS protocol? And really the biggest thing is going to be if the fund has enough people saying yes, or just people are doing individual checks to whatever, because we do have a protocol in some respect. We have like background checks that we do, like there's stuff that happens. We should also be asking like, can you just share a simple balance sheet? How much money do you guys have in the bank? I need to like timestamp it, and then that's going to go in the archives and it's dated. A balance sheet is the most that most people are going to get, like as far as like rinky-dink startups, excuse my language. Silicon Valley has definitely like taken a hold of QSBS. They know how much appetite there is for this sort of thing. So like a lot of the folks I work with, we haven't even described it. Like I do wealth management and tax strategy for folks in and around Silicon Valley, usually early employees, but like now it's late stage. And now there's like equity to deal with and it's a tax mess. Or it can be if they touch anything. A lot of these folks have, accounts at Carta. Carta's definitely the big player in just, instead of a Schwab account, I have a Carta account. It's got like all my details of all my equity in there. And what you'll see is Carta is starting to help people come up with like a QSBS, like a letter of attestation, where the CFO or some HR person knows that everyone's going to be asking. And so like at the purchase, they'll just have like a pre-written letter that says like, as far as we know, like this qualifies and here's my signature, and like you can download it. So for a lot of the folks I work with that have stuff in Carta, it's actually like there, and we just like download it and like now it's in my files. That is on the hyper organized side of things, right? Like these are companies that are like heavily funded. They know that that's like checkpoints that their, early LPs are looking for, right? That's the whole game that they're playing. We need to start doing that stuff at the lower level definitely with local angel groups. Like, what's our, poor man's version of a letter of
Mm.
attestation or anything, right? I don't know if we're going to be able to get every like startup to have like a formally written like typeface and everything, but if we can get our hands on the balance sheet, that's big. That's that's honestly most of the battle. You just want to prove that the company was set up as a C corp, so articles of incorporation, not hard to get. Pretty much every investor is going to be able to get those, but then also like balance sheet, which is basically money in the bank that says, hey, we don't have $75 million
Mm.
at this point in time, and that's a really good start. And we need to evangelize that for everyone.
Which is, I mean, everything you're describing is fairly common diligence material in most angel groups. The individuals who are investing are often relying on the group to do that analysis. And so this speaks to, I think, one of the biggest values that a group brings to the table is at least a light level of sort of, it's not institutional grade, right? Because these angel communities are often volunteer or educational, in nature, but there is some structure to them whereby some sort of centralized group is building a protocol around this that's then available to individuals to kind of help collaborate with. So
Yep.
I love that. And I totally agree. Let's evangelize it together. So that's
We're
why
gonna
we're
make
here.
it. Yeah, I'm gonna make it. So um the next thing is, how does this actually happen on a tax return? That's like, because it's like the reality is, how does QSBS happen? Where does all this tax savings like magically come from or like go? It all gets, it's just like anything else. It just gets reported on the tax return. So in the year that you sell or you get cashed out, happy things happen, right? And the year that the happy things happen, you're gonna have to like do your taxes. And just like if you like bought and sold in your Schwab account or your Robinhood account or whatever you're trading in, you're gonna do the same thing with your, you know, startup investments. You're gonna say, I bought it for this and I sold it for this. You're still gonna have to like list that out. But when it comes to QSBS, there's more to the form where you're kind of listing everything out. And there's like there's another one that's like, there's another line or column that's like for adjustments. And the adjustments is where you're gonna like write it. And there's gonna be a little like section, or it's like a code box, and the code box letter is Q. So it's like a Q box. So that's like the biggie. There's like another like worksheet where you kind of like fill in more information. The reality is like, this is dangerous. This is not tax advice, all those caveats, things like that. But I mean, anybody, you can just write that out basically, right? But then it becomes, and you can go for it, knock yourself out. But then you know, it's on you to have the supporting data, because the reality is QSBS is one of like the low hanging fruit for the IRS. Like when they see it, a little flag is going to go off,
Mm-hmm.
because you're literally trying to say that you're going to pay zero taxes.
On the winners, right? Not on,
Yeah.
nothing outcomes, on like the big outcomes where there's massive value creation.
So now you've officially just put a target on your back, and your odds of getting a letter are high, especially if you're high income already. They were wanting to come after you anyways. So now they have a good opportunity to do so. And you have to come up with all the supporting documents that proves that you hit all these checkpoints, and it's on you. And a thing that I am, I'll say, disappointed with time and time again is many CPAs, tax professionals, have very little experience with this. Oftentimes they don't know what I'm talking about when I bring it up. It's because, I mean, there's big money that we're talking about. Venture knows about this, it's going after it. But like the majority of the world, 95% of the world is not, you know, investing outside capital in small C corps. It's like, it's just not
We're just taking
happening.
the
Right?
standard exclusion and maybe some charitable every year, and that's it.
There's a lot of business sales that happen, right? Like I sold a business, but those are like, those are successful small businesses. Those are normally like, those are LLCs or S corps. They're just like normal mom and pop, like successful things. Most aren't C corps. Like C corps are like actually kind of an inefficient entity vehicle. you do it for a few reasons, but the big reason that it needs to be a C corp is that you can have different classes of shareholders, maybe to delineate like, all right, you get what I'm saying.
Yep.
But it's just not as common. So a lot of tax preparers don't even know about QSBS, and you have to be careful who's filing your taxes if you're trying to claim it.
Good question to ask. If you're listening to this, ask your CPA if they know about QSBS. And if they don't, send them this episode. Be a great start. Brian, anything else on QSBS? I want to make sure we get enough time on the other side of the outcome.
Well, there's more on the fun stuff, so we might as well just stay on the fun stuff. So, big thing that happens, big question is like, okay, you said I need to hold my actual equity for 3 to 5 years. If I held for 3 years, I get 50% off my gains excluded. If I hold for 4 years, I get 75% of my gains excluded. If I hold for at least 5 years, I get to exclude 100% of my capital gains exclusions. What if I have an acquisition? My little startup did really well, and they're getting acquired, and there's a liquidity event, but I've only held 2.5 years. What happens? It's frustrating. It's frustrating. All this money that I have now, it's so frustrating. You want to pay tax. Are there any tools or tricks available to me? And the IRS has one for it. It's called a 1045 rollover. For our friends who are familiar with real estate, there's a thing called a 1031 exchange where you can like sell your building or your rental property, and you can, instead of paying taxes on the sale proceeds at that time, you can roll the whole proceeds into the next deal, and your cost basis follows you, and so does your like date of purchase of the original one. It continues on, and you can just keep expanding the balloon over there. You can do something similar with startup equity. That's what a 1045 rollover is. You can take your equity that you cashed out. You'll need to roll over, find new startups, either one or I think a fund would count, but don't count. I think it would count, but don't quote me on that. I'm pretty sure folks have done that before, though. I think there's a certain amount of time that needs to go by. It's not like a crazy amount of time that you'll need to have identified the new startup and then invested the proceeds. So like there's a little bit of a stressful time crunch there. But if you do, you can invest in the new stuff, and it's a rollover, and your date you can continue on. So I can keep that 2.5 years I've accumulated and let it sit for longer. You can cash some out and then roll over some. Like you can get kind of creative with it. But a 1045 rollover it's a big deal if you're trying to preserve.
So this means if in that situation, company 1 exits 2.5 years within whatever the period is, let's guess 6 months, I deploy some portion of those dollars into company 2, my 2.5 year clock continues uninterrupted, essentially. So then if company 2 exits in 2.5 years, I get to treat it as if I had been in that business for 5.
That's correct. Yep. Also, very important, another good planning strategy is around gifting. So if I decide to gift my startup equity to, let's say, my child or my children, the basis carries over, and so does the time accumulation. And this is where a very, very advanced, which I don't see too much. I only work with like regular rich people, not like, Rockefeller rich. But there's a strategy that's out there called trust stacking, or QSBS trust stacking, where I'm going to create a little entity for each of my kids or each of my family members that I want to give shares to. Because I'm like, well, I don't need this money, but I think it's going to be big. You start to gift shares into a bunch of little trusts that you've made for a bunch of different people. And every for each individual, they get their own QSBS limits.
Interesting.
It
So
gets
the 15
crazy.
million, for example, doesn't get chopped up. Each slice gets its own 15 million as a result.
That's right. It's per individual.
Wow.
Yes. Now, it only makes sense if you had the foresight to do it early. If you're like, there's a bunch of things that could blow it up, right? Like the IPO is like tomorrow and you did it like today. They're like, we know what you're doing. That doesn't count. Also, if the valuation's really, really big already and you're trying to make a large gift, there's also standard like gift and state tax like limitations that normal people need to be aware of anyways. Like you're gonna blow through that and like you might end up owing gift tax. So like it's a super good thing to know about in like very niche cases, but more food for thought, I guess.
I love it. Fun to think about. Okay, well, I do want to make sure I get to the other side, which is very common, right? This is going to be the average portfolio. I had John Harbison on this show. He's at TCA Venture Group, one of the most data-driven investor communities. Had amazing data on this show to talk about how in the first 5 years, most of your outcomes are going to be, shutdowns or 1x or around that, and then it's in the year 5 to 10 plus that the winners really start to show up. So walk me through some of the things that you've found many angels aren't thinking about or aren't as familiar with, and how they can optimize some of those shutdowns, because there are benefits with a shutdown with a loss.
Such a bummer topic. Such a bummer topic. Let's assume that none of your investors, none of your audience members are going to need to know this, but tell them about it. So let's go back to if I have an account of like Charles Schwab or something, like I bought, whatever. I bought Bitcoin at this, and now it's worth way less, hasn't gone to zero yet. No, just kidding. If you sold it at a loss, it's a capital loss. Everybody is allowed to take those capital losses and use them on your taxes. It ends up helping you, actually. Capital losses, if you don't have other things to like offset it with, the most you can take in any one given year is $3,000 in one given year. So if I lost like, we'll keep it easy, we'll keep it nice. If I just lost my $10,000 in like one deal or one check, I could write off $3,000 in that 1 year, and then the other $7,000, I don't lose forever. You just have to like kind of roll them, keep carrying them forward until you burn them up. Basically, that's the normal rules. Capital losses, like everybody gets those. For startup investing, there is a special line of tax code. We'll just lovingly call them 1244 losses. So 1244, another code, IRS tax code, right? This is not related to state taxes. And this says that if you were an early investor in a startup and it hit a few like thresholds, or a little bit different than the QSBS like criteria, but if you had a few different criteria and then you lost and it went to zero, you can write those losses off as ordinary income losses, which is way juicier than capital gains. I think I was saying capital gains rates, even on the high side, like 23.8%. Ordinary income can be, up to almost 40%. And what you can write off is you can write off more than just like 3,000 in a year. These limitations are what you're allowed to write off. I'm double checking my numbers to make sure I don't say the wrong one, because we're throwing around a lot of numbers, but basically $50,000 per person. And if that's important, because in this case, if you're married, you get 100,000. And so, it's a lot of losses. But you can get up to $100,000 off if you write it off against your ordinary income.
To my
which is,
personal family, joint return.
yeah, just normal income, just hits your normal income. So that's great. Uh, the big things are, let's see, I'm trying to get the exact language, but at the time the stock was issued, or the time that you invested at that time, the corporation itself, and I think this can actually be a C Corp or an S Corp, but the rules are changing. Um, the corporation must have received less than $1 million in exchange of the stock. Meaning they have raised less than $1 million. So if they're doing a mega raid and we're raising $4 million this round, like too big. But if they're like a lot of groups and they're only raising like, to 500K or something like that, you're still considered small for this. This line of tax code doesn't use like the qualified small business lingo, so you're not gonna see the word small business, but that's their definition of small.
It's
In
under
this
$1 million
case,
raised, essentially.
raised, correct? Yes. So that one is probably like this is how it always goes. We spend all the time talking about like the really like sexy romantic one because then like it's very juicy and attractive to go after. The reality is that most angels should be paying attention to 1244 losses. The punchline with all of it is if you are going through any exit at all, or you're about to, you see the writing on the wall, it's time to get your ducks in a row and make sure you have any documentation for anything, because you're going to have to prove that you wired the money in. You have to prove what size the company was at the time, which all goes back to QSBS, or I guess in this case, 1244 protocol for angels, which we all desperately need. And you really don't want to be scrambling around tax time to find information that maybe doesn't exist anymore. Yes.
Well, Brian, this is fantastic. I mean, two really important tools for every angel to be aware of. Obviously, there's a massive amount of nuance on both that we can't cover in a 45-minute conversation. But any other thoughts or final encouragements you would have for the angel who's looking to be more thoughtful and strategic about their tax strategy?
Yeah, this is where it gets tricky, because I believe, well, on one hand, I believe every investor, or even if you're like an early employee at one of these like startups, like everybody should be empowered with this information. But it's not an excuse. What it might accidentally do is it might start making smaller startups more attractive, or startups that are, let's say, an early stager that is actually offering direct equity and not via safe. And you're thinking, oh yeah, Brian said that safes don't count anyways, and this gets my QSBS clock started, and they're offering the information up front, so I have it for my records. I've actually been seeing quite a few deals where they're doing their pitch, and they're even saying in their pitch, this is QSBS eligible.
Mm.
And they're saying that, meaning they know what's attractive to the investor. And so you might think that that's like, wow, that's attractive. And it is. But you really have to go, it's like, I have all this information, but do I actually use it for any of my very disciplined, diligent investing that I need to be doing? Because I could just throw money around and lose it all when I was trying to get QSBS. So it can be distracting, I guess, is the point. So it's a tough balance. And so I think our goal now, at least with our group, and what I hope to be able to share more with just like the entire, country of investors, is how can we make just the upfront protocol really easy and mindless, so we're actually not thinking about it. We can like move on to the more important things, which is this a good company that's going to return anything, which is the only thing that matters at the end of the day.
Yeah. So your point is this, a company raising on a safe or a convertible debt instrument or something else isn't necessarily a bad deal, and we shouldn't just pass because it doesn't qualify for QSBS right now. It might still be a great investment even without QSBS. This is just a feature to know about that the U.S. tax code makes available to angels in some certain situations.
Yeah. Icing on the cake. Yeah. Where also, it's a side point, where you live also is important, right? Texas, where we both are now, no state tax. California, where a lot of my practice is, California itself has state tax and does not comply with any of the QSBS like exclusions from the IRS. But New York, on the other hand, does. And so you're starting to see actually that affect where startups and startup founders want to live, actually. Even like across the water in New Jersey, I think that, different rules over there than it is in New York. And so people are influenced by this. Venture funds are aiming for this. There's no reason that every angel investor shouldn't also be completely aware that it is available for them too.
Well, thank you for your time today, Bryan. That has certainly helped achieve that goal. Very, very much appreciate you taking the time to walk us through all of this, and I look forward very much to our next conversation.
Yeah, this was fun.
Thanks for listening to this episode of The Diligent Observer. I'm your host, Andrew, and if you're an angel investor looking for essential angel intel in 5 minutes every week, I think you'd enjoy my newsletter. I send my best stuff, interesting deals, and more straight to your inbox so you never miss a thing. Subscribe today at thediligentobserver.com.